Are you ready to explore the fascinating world of behavioral biases in investment decisions? Welcome to Business Mind. In today's video, we'll delve into various cognitive biases that affect our choices when it comes to investing money. Before we start, if you are new to our channel, please don't forget to subscribe and hit the notification bell below to notify you on our next Business Mind updates. Overconfidence bias. Consider John, an investor with a 7-year track record who predicted a stock surge from $180 to $250 based on his past successes. Confident in his abilities, he invested 20% of his net worth in that stock, ignoring other factors. On the other hand, Smith, influenced by a friend's claim of doubling money in 2 years through an investment scheme, plunged in without fully comprehending it. These scenarios exemplify overconfidence bias. John in his investment prowess, and Smith in blind trust of received information. Overconfidence bias poses significant risks, making its mitigation crucial. To counter overconfidence bias, informed decisions are key. Conducting fundamental and technical analyses before investing can offer a balanced view. Novice investors may benefit from seeking guidance from financial advisors. Additionally, maintaining a margin of safety helps cushion against potential errors. Overcoming overconfidence bias demands prudence, acknowledging the limits of individual judgment, and embracing a more rational approach to investing. Regret aversion bias. Consider Jane, who invested in a stock despite foreseeing minimal potential for loss. As the stock value dwindled over time, she hesitated to sell even when losses were smaller. Eventually, the stock significantly declined in value. Jane's reluctance to sell earlier stemmed from a fear of regretting a wrong decision, illustrating regret aversion bias. This bias often leads investors to hold on to declining assets to avoid the emotional pain of acknowledging a poor choice, resulting in wasted time and money due to missed opportunities. Overcoming regret aversion bias involves setting predefined trading rules and adhering to them. For instance, implementing rules like selling if a stock drops by 10% or booking profits when it rises by 15% can mitigate this bias. Regularly reviewing investments and rebalancing when necessary helps in objectively assessing their performance rather than solely avoiding losses. By establishing clear guidelines, investors can counteract the impulse to hold on to underperforming assets to evade regret. Trend chasing bias. Take Mike, for instance, who invested in XYZ Limited solely because it exhibited a 25% return in the previous year, showcasing a trend chasing bias. This bias reflects how many investors base their decisions predominantly on historical returns, disregarding the adage that past performance doesn't guarantee future results. Relying solely on past returns can lead to flawed investment choices due to overlooked crucial factors. To counter trend-chasing bias, while tracking market trends isn't inherently wrong, solely depending on historical performance poses risks. Instead, investors should delve deeper into assessing a company's fundamental strengths, weaknesses, and current standing before making mindful investment decisions. Evaluating factors beyond past returns, such as a company's financial health, market position, and growth prospects, enables a more holistic approach to investment. By focusing on comprehensive analysis rather than solely chasing trends, investors can make more informed and grounded investment choices. Are you here for financial success? The path to it is full of challenges, but don't worry. Business Mind is here to help you dream big and achieve bigger. Check the links below, and who knows, your success might just be one click away. Confirmation bias. Consider Peter, an investor in ABC Company, who, despite thorough research and a long-term investment plan, encountered news of potential bankruptcy due to serious litigation. Ignoring this information that conflicted with his optimistic view, Peter displayed confirmation bias. This bias drives investors to seek and believe only information that aligns with their existing beliefs, disregarding contradictory data. Overcoming confirmation bias requires actively considering all relevant information impartially. Investors should strive to give equal weight to diverse perspectives and information, even if it challenges their preconceived notions. Verifying the accuracy of information before making investment decisions is crucial. Embracing a more open-minded approach that encourages critical evaluation of both supporting and opposing information helps mitigate the impact of confirmation bias. By fostering a balanced and objective assessment, investors can make more rational and well-informed investment choices. Loss aversion bias. Consider Sarah, who hesitated to invest her $50,000 savings in mutual funds or stocks due to her fear of potential losses. Despite the likelihood of inflation eroding her savings value, Sarah's apprehension about losing money highlights her loss aversion bias. This bias refers to the tendency of investors to prioritize avoiding losses over pursuing potential gains, which can hinder investment growth opportunities. To overcome loss aversion bias, understanding one's risk tolerance is crucial. Tailoring investment decisions to match individual risk profiles helps mitigate this bias. Being open to calculated risks, especially when the potential for long-term gains is high, is essential. Additionally, building a well-diversified investment portfolio can reduce overall risk exposure. Rather than avoiding risks altogether, minimizing risks through diversification, while aligning investments with personal risk tolerance, fosters a more balanced approach. By embracing a mindset that balances risk and potential rewards, investors can counter loss aversion bias for better investment outcomes. Herd mentality bias. Take Richard, for instance, who followed the crowd into a hyped meme stock due to fear of missing out on significant returns. His actions exemplify herd mentality bias, where investors blindly follow others without independent analysis. This tendency to go with the crowd rather than conducting individual assessments can lead to adverse outcomes. To overcome herd mentality bias, conducting thorough background research on a company before investing is crucial. Avoiding the fear of going against the crowd, especially when data suggests it may not be a prudent investment decision, is important. Emphasizing independent analysis over blindly following market trends helps counter this bias. By focusing on individual research and analysis rather than succumbing to herd behavior, investors can make more informed and rational investment choices, aligned with their goals and data-driven insights. Availability bias. Consider David, a novice investor who chose a mutual fund solely from an advertisement, without exploring other options. His decision based on the readily available choice exemplifies availability bias. This bias leads investors to make decisions solely based on easily accessible information, without seeking additional or diverse sources. To overcome availability bias, thorough assessment of all available information before making investment decisions is essential. Investors should actively seek out various sources of information beyond the easily available ones. Furthermore, verifying the accuracy and reliability of the gathered information is crucial. By emphasizing comprehensive research and due diligence, investors can mitigate the impact of availability bias. Striving for a more exhaustive evaluation process, rather than solely relying on the easily accessible information, helps in making more informed and rational investment choices. The Business Mind verdict. Navigating the world of investments isn't just about numbers and market trends. It's equally about understanding and managing our own cognitive biases. From overconfidence to herd mentality, these biases can significantly influence our investment decisions, often leading to suboptimal outcomes. Recognizing these biases is the first step towards making more informed and rational choices. By acknowledging our tendencies and actively implementing strategies to counteract these biases, we empower ourselves to make wiser investment decisions aligned with our financial goals. Remember, it's not about eliminating these biases entirely, but rather about being aware of them and adopting techniques to mitigate their impact. Whether it's conducting thorough research, setting predefined rules, or seeking diverse perspectives, these actions can pave the way for more prudent investing. Now, are you ready to take charge of your investments and navigate through these common biases? Join Business Mind, where big dreams become even bigger achievements. Don't forget to like, share, subscribe, and hit the notification bell below for more empowering content to elevate your business journey. Dream big, work hard, and see success beyond your expectations. Thank you for watching, and see you next time. Business Mind, signing off.